I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. This morning in our group coaching class, where we give trade ideas every day, we talked about one particular trade in Carmax, symbol KMX. Now, we are entering now earnings season, and this was an earnings play. Now, I will tell you off the bat that earnings trades can be really tricky. Earnings are very unpredictable. Even if you can predict exactly what the earnings figures will be, earnings per share figures will be for this quarter, you still don't really know how the market will react to it. So big moves can happen on earnings days, and that makes trading really tricky. But one other thing that goes along with earnings is a rise in implied volatility. Now, implied volatility, of course, is how cheap or expensive options are. What tends to happen is the term structure of implied volatility gets sort of out of whack. The short-term options get really expensive in terms of implied volatility, while the farther back options don't. Now, this creates a disparity that can potentially be capitalized under the right circumstances during earnings season. Now, the trade in Carmax this morning is a perfect example. What happened is there's no weeklies in Carmax. The April options, which expire in about 16 days, are the shortest term options available right now. Their implied volatility was really high, close to about 60. And then the May options, their implied volatilities were still pretty low, in the very low 40s. So the trade that I liked was selling the April 57.5 calls, and then buying the May 57.5 calls. So this is a classic time spread. Now, on the one hand, you look at a time spread and you think, well, yeah, if there's a big move in either direction, the time spread gets in trouble, so why would I want to put that on going into earnings? Sometimes that's very sound logic, but in this case, I think that there's a benefit to this that outweighs that. The benefit is that the price that I could sell right now, those April options, is so extraordinarily high that it moves those break-evens so far apart that a humongous move, way bigger than has happened during any earnings announcement for the past 2 years, would have to occur for this trade to not be a winner. So this disparity in the April volatility and the May volatility, once again, is called term structure of volatility, and there's a very large disparity. And because of that, because the break-evens are so far apart, it becomes a very high probability of success trade and potentially a high profit trade. Now, if I were to put this trade on my time horizon, would be to get out of the trade the very next day, sometime, probably around lunchtime, once the implied volatility of that front month option collapses. When it does, then that option gets a lot cheaper. I can buy back that cheap one and sell the one that I bought for mostly pretty close to the same price that I bought it, as long as the stock doesn't make too large of a move. So that's a brief synopsis of how to use time spreads during earnings season. And by the way, folks, we've got a class on time spreads this entire month. It's a 4-part series all on time spreads, during which we're going to be covering earnings trades. Now, you can learn more about this class by going to MarketTaker.com. That's market like stock market, taker like take something, so 2 T's in a row. MarketTaker.com/options_education. I'm Dan Passarelli of MarketTaker.com. Trade well.